All right. Good morning, everybody. Let me get a sound check 'cause I got this warning telling me something maybe ain't working. So somebody tells me they can hear me, we can go. Otherwise, I'll go mess with my settings. Thank you, sir. Thank you. Thank you. All right. So we're red around the world. The Dow Jones is down the least, followed by the S&P and then the NASDAQ, and the Russell's down the most out of our markets. Hong Kong is leading globally to the downside, down more than 2% and much closer to 2.25, really. Japan is less than a quarter to the downside, so it's looking at least a little bit better. But so far, we're still carrying on from last week with that negative bias. We don't have any large economic events on the schedule today. And we can see that going to Market Watch. There's just nothing here. Now, it's not to say that there aren't any events at all, just that from Market Watch's point of view, there really isn't any that are big enough for hitting their list. We have European Central Bank Speaker Christine Lagarde today. That would be like having Powell talk. So when she talks, pay attention, watch the news. She absolutely can move these markets. Then we're going to get some manufacturing numbers and additional auctions at 11:30. So kind of a quiet day. Once we get past Christine Lagarde, we're pretty good to go. Apple having some more issues. This time it's a factory in India going to cause them assembly for at least a day. Yeah, it's going to be a pretty quiet day, it looks like. And that's not necessarily a bad thing. We got the German 10-year making a run for it. It's at the highest level that it's seen since 2011. So the thing you really want to watch for this week is any continuation on the narrative for energy. Right now, that's front and center with everybody. Higher energy, higher inflation. And then yields. Last week, we were all watching Japan's 10-year. Right now, we got the German 10-year making a run for it. We had the US 10-year getting out of control. So those two main windows, what you're going to want to keep your eye on. (8:30, 10:30, and 11:30). So 0-day plays are in effect today. If you can get through the other side of lunch, you'll have some clear window into the afternoon for your 0-day plays. All right, so last week I talked about how we opened this week, and I would rather open gapped down than gapped up, right? It's just, especially when we're sitting down at these lows. And so far that's what we're getting. Now the turnaround doesn't have to happen first thing this morning. We just need to see that this market really is going to attempt to make this double bottom bear trap and then flip things over again. So being down this morning, having broken out of last week's range, flirting with that nice round number 43.50, all of that makes perfect sense, especially if we're going to try to take it back up again, right? If they had front run it and we hadn't actually gone down to that level, or if we had bounced on it perfectly and had gone back up, that would make me a little more suspect. But so far, everything's doing kind of what we would want it to do, and we just want to let it play out. The volume's not overly heavy, and so no real big alarms are going off from that either. Few things that we want to do with that weekly chart is measure last week's candle. One is because it's last week's candle, but two, it's also the biggest candle around. And we always want to pay attention to the biggest candle that we have, the one that's closest and the biggest candle. So if we just look at the quarters, kind of a quant measure, right? If I was to go in here and go down to the quadrant tool, it would draw it similar to this. Then our 50% line in the sand is 44, 35, and 3 ticks. A continued move to the downside with a 50% measurement is going to get us really close to that weekly 50 period moving average. Now there's a moving average that I don't use it very often, but is in analysis textbooks frequently. Is a 30 period moving average on the weekly at least. I like the 34, but I've never seen a 34 in any of the analyst books. I have seen 30s. It's worth kind of thinking about, where's that 30 period at? And are we going to hit it? And obviously we could put any number on there, right? If we put enough moving average numbers on there, then we'd be able to have, every point their price would be hitting something. So it kind of gets a little arbitrary after a while. If you've gone through enough analysis books and things like that, they'll talk about why certain numbers and moving averages are popular, right? They'll correspond with a week or a month, right? 20 days is a market month. 20 period moving average is a very popular moving average. It's not a coincidence. So 100 and 50 and 10 and 20, they all have a reason to be used. Same with this 30. So it's not as arbitrary as it may sound that I'm talking about the 30 this morning and the fact that we could hit it. There's a reason for the different numbers, right? So 43, 34, if we continue to the downside, and it's actually through the ADR half, which we'll get to in a minute. But it's a number that I'm particularly keeping track of. And if we put my warning labels back in, my warning center at 111, and then the 1, 2, 3, 6 from last week's candle, looking at 44.39, excuse me, 43.39 and 43.20. So we've got a lot of numbers to deal with here. 57, 39, 34, and 20. All right, I mentioned the volume. We're at somewhere around that 125 number. It's normal, it's fine. It's not enough to be, considered extreme, and it's definitely not too light. So it's kind of that sweet spot. $43.42 is the ADR half. Cog line at 43.32. The full ADR 43.19. Cog line at 43.11. And then another voodoo line at 43.07. So if we transferred some of those drawings from the other time frame, you can see how the 1, 2, 3, 6 lines up with the ADR full. It's always nice to get the same number when you approach it from different tools, right? This helps avoid confirmation bias or multicollinearity. It's a nice word to look up first thing in the morning on a Monday. You want to get your answers from different sources so that you don't end up in an echo chamber, right? $10-day, 30-minute volume profile. When we're at the highs, we expect to go to the lows. When we're at the lows, we expect to go to the highs. We are starting to develop into a classic B. We're not quite there yet, but the longer we spend through this lower section, we'll start to build this area out. If we can break back above 4,400, the rounding, then we can start to move through this shallow area. And that's an area we should be able to move through relatively easy. You can see how we didn't leave much behind the first time we went through there. It's very likely that we can move back through it just as easily. We are starting to set up a little bit of a TRB, trend line breakover. So that's what I would be looking for, getting through that roundy or getting through this pivot point here from Friday and starting to transition through this shallow area back into, say, the 4450s, 4460 area. We've got a long ways to go to that point of control. And for us to bring the point of control down to us, then we would really have to start basing here and quit making new lows. So far, we're not doing that. We're going to move this point of control from Friday, but it does look like it might have been hit. So let's just bring it down there and look. And whether it's been hit or not, I'm going to keep it there all day today, either way. No, it hasn't got hit, but oh, it sure was close. All right, so there's our VPOC. And if you consider the fact that it was close, and what that kind of signals, think about all of the volume that's right there at that point of control, right? And it's more of like the shape of a cone than a very sharp line, right? The way they teach when you're drawing on a chart and you're, presenting data is imagine that you're not using a very sharp pencil, but instead are using a very dull crayon. That you want to think about wide lines and wide zones. So that point of control didn't get tagged, but the zone around it is wide enough that we basically got up into that old volume and we took that rejection. Even if we didn't get right to the line. Either way, it's an untouched point of control, so we're going to leave it on there. We are beginning to set up a little bit of a classic H pattern. This is something that Peter Resnicek likes to say, H is hell for shorts, right? Now, don't necessarily think this is looking, overly bullish at the moment. And we are starting to form perhaps a little bit of a new micro double bottom as opposed to this bigger double bottom or this double bottom. But if we were to use this double bottom and say that it's a bear trap and it went through and it trapped all the bears and it made its way back up, there's a couple of arguments with it. One, I would say we went lower than we should have, right? If it was going to just be a regular classic double bottom, it really shouldn't have gone so deep. And then second of all, the move back up stalled out. And now, of course, we're getting that breakdown again. So it's easy now to look at it and say, oh yeah, no, that double bottom failed. It wouldn't have been so easy back here, right? Especially when at this point, it hadn't even failed yet. It was still doing what it was supposed to do. Just look at the depth of that move, right? If the double bottom started at 43.57, then it really shouldn't have gone down to 67. I mean, that's a pretty deep drop through, right? It's not supposed to go that far. So that would have been one warning. That tweezer bottom was a really nice flip signal for the move back up, but then it stalled again right at yesterday's low and really just couldn't seem to keep it. At this point, when it was going sideways, this was a lot of warnings that the follow through back up wasn't as strongly anticipated at this point. Maybe we wouldn't have still thought we were going to go down, but we certainly would have tried to get out of any longs at this point on the idea that hope is a really bad trade strategy. And just sitting in it, hoping it's going to continue to go up is not a good idea. So you could have at least had enough warnings to get out of your longs before this. And then if you weren't in at all, then you had some nice breaks for entry to the short side. Now we've got a new micro double bottom. This looks a little bit like they're fishing for liquidity. And now that we do have another double bottom, we can anticipate perhaps a new bear trap. This one might work a little bit better than the last one did. It should still expand, enough to trap a bear. It should be enough to be convincing. If we use this micro move, or this micro measure, 43.44 would be our warning center, kind of our line in the sand. And if we get down to the 1, 2, 3, 6, then we have to kind of look at this and then look at that continuation and argue that maybe it's not a double bottom. So if it gets that far, then it has again moved too far to the downside to be considered a double bottom bear trap, and that it's more likely a continuation. Should we get through that zone and continue to the downside, the measured move for the next leg down is the cog line 43.32. So here's a warning. We stopped right on the line. We're not supposed to stop right on the line. I guess we missed it by a couple of ticks, so they front runned it just a little bit. Either way, that's not bullish, right? So just take that with a grain of salt. Now it can go up from here. I've seen it happen, right? So I'm not telling you that it's guaranteed going down, but this formation and this setup is not how a normal bullish response happens from this location, right? So I would be very cautious about trying to run it back up. If it had broke through, and given us a true bottom, then true double bottom, then I would look at it much differently. Okay, the volume this week is definitely bigger than last week's. We can see that just by measuring this box. That was last week's range. And this is this week's range. they expanded the volatility that much. That's a lot, right? If we were to take that box and set it up here, it's more than 50% more than last week's, right? So when we get a higher volatility, it's got a lot of implications to it. Options are going to be a little more pricey, but it also means that movement is getting a little bit bigger, right? The volatility is a measurement from close to close if we're looking at a stock chart. So one day's close to the next day's close is how implied volatility is measured on that daily chart. Obviously, options don't have the same kind of metrics. And of course, there's a square root of time formula, and there's more to it than just candle close, but candle close is a large part of it. So when we say that volatility is increasing while we're looking at a stock chart, it's implying that the distance from one candle's close to the next candle's close is increasing, and that while a candle is open, it is traveling farther or making bigger moves, aka it is volatile. And so that's the warning that we get here. For us to hit the lower end of the weekly expected move this week, we will come into contact with the anchored VWAP that I have here. It's something that we don't talk about very often because, well, I mean, all year we've been above it, so there really hasn't been much to say about it. But it's in range now. So first touch play, and it is on a cog line, so that helps a lot. If we get there, we're very likely going to bounce at least once. 43.11, keep your eye on it this week. It is a significant level. It's anchored from the first of the year. If you want to learn more about why we anchor at different locations and how anchored VWAPs can be used, TrendSpider's got a nice PDF on it. And then there is something called the Boulevard. They've got some good YouTube videos, and they share some Thinkorswim anchored VWAP studies. Should be able to find them easily through a Google search. It's pretty interesting stuff, right? Anchoring a VWAP at different places like earnings, the start of a new year, the start of a new week. If we consider VWAP fair value or average price, then all year the S&P, and we're looking at it through the futures, but either way, the S&P, for the most part, has been holding above that level, or at least since March, right? We've been through that level. So we've been riding above the average. And now we're going to come back into contact with it. First touch play, as I mentioned back here. First time we hit it, very likely could bounce. Just remember, support and resistance is in the past, right? Something is only support when we look back later and say, oh, wow, look, it did support the market. Until then, things are potential support and potential resistance, and moving averages, VWAPs, trend lines, none of those are support. None of those are resistance. We are nearly 2% below the 10-week. We've been lower than that this year. But it's been since March that we've been this far below the 10-week. So it's been a while. The 10-week can also be, a line in the sand. If you go through a lot of analysis textbooks, the 10-week is a really big deal. So if we get below 2%, we're going to look for 3%. That will be the next goal to the downside. 3% distance from the 10-week moving average. but we would have to get a candle close, which means a weekly candle closed below the 10-week before we would then consider that next distance, right? Let's swap this to a daily. And we are 2% below the 10-day moving average. We've been lower than that this year, but not by much. And it was, maybe it was last year. It's pretty close. Right? We're just about as low as we've been on the entire year, unless we want to nerd out and get crazy super specific with it, but we don't need to. We can just kind of look at it in that bigger picture and say, yeah, it was pretty negative out there. Thing is, that's pretty close to a reversal point, right? And the narrative will change for why it goes back up, but think about why it went down. When some company has a negative report and it goes down for whatever reason, news, a drug trial fails, they get a lawsuit, whatever. When they go down because of something, then at least we can point to it and say, yeah, lowered earnings, their product explodes. There's a physical thing that we can point to. The moves that we saw last week were based on sentiment. People lost that warm, fuzzy feeling, and maybe they actually started to pay attention a little bit to what the Fed has been saying, because the Fed didn't really come out with earth-shaking revelations that we didn't already know. They've just said the same thing they have been saying, and maybe the market just heard it a little bit now, right? So they're pulling forward some of those cuts, or they had been pulling forward some of those cuts, and now they're trying to readjust or unwind that. So these moves to the downside, I wouldn't expect them to continue. And the save-a-hole move that will come doesn't have to be because the Fed runs out and starts buying a bunch of stuff. They don't even have to start cutting rates. All they got to do is suggest that they're going to look at the dot plot differently, or in any way, shape, or form mention any sort of easing. And we start pulling some bricks out of this wall of worry. Government shutdown looming as soon as this weekend. That's one of the bricks in the wall. The 10-year out of control. It's another brick. So we got a lot going on, right? We talked last week about the market not willing to sit forever in this hurry up and wait mode, and that it would get impatient and just dump stuff just to clear the board and start over. And I think that that's a part of what we're seeing, right? Seasonality suggests we're going to have a bullish winter, but it also suggests that it'll get a little uglier first before we get to that, right? So if you want to look at some seasonality charts, there's a couple floating around out there. Bank of America or B of A, they usually have some pretty good seasonality charts. Should be able to find them, and I hate that I'm even saying it, but you should be able to find them on Twitter, right? Just remember, take seasonality as, you know, a suggestion of what could happen. It's not a line in the sand. So all of that kind of sets us up for the idea that we're going to start the week. That will stay a little soft, and that at some point through the week, we turn and we begin working our way back up. So we do have those China ADRs down the most, with Bitcoin right behind it, and then bonds all down the most. The FANGs with semiconductors and technology is down, but only by 0.25%, so not enough to hit our benchmarks. Things that are up this morning, uranium still running like a mad demon, and nat gas. Nat gas isn't up enough. Never mind. We'll just throw that one right back out the window. So uranium. This space has just been fantastic. Okay, so you can see uranium here from October last year, kind of just chopped around while the S&P was coming up off of those October lows, and having the crazy AI advance through half of this year. This thing from October just really was going sideways, chopping about, doing nothing, basically through all of this zone. And now we got that trend line breakover in August, and it's just been on a go. We are getting up into some critical levels though, so I would approach with a little bit of caution. You can see if we go back to May and June of 2022, how we have this topping pattern here. We're coming right back into it at 46.66 area. And if you look at it on the daily, this is a little bit of a concern. Now it's a megaphone pattern, so we're starting to get a little bit of that expansion. We can consider the controlling candle. And this morning, we're going to be opening up underneath this red line. So we're opening way up here. We are inside day breakout, and we're already broke out of this entire range, which is fantastic. But just a note of caution, that nice consolidation here and the megaphone pattern and the pause to consolidate, and now the gap up, it seems fine. I'm just a little concerned about a blow off top. So, back here we had a nice consolidation after a gap up, and then it gapped up again, and it just, had that really beautiful move. Same thing, really tight consolidation down here. And then it gapped up, in a nice move. So it could just be a new leg up and a new move. And it's not, one single name either, right? It's the entire space. So if the long is wrong, you ought to know pretty fast, because it's all going to start to unravel really quick. Think about Thursday into Friday and now into today. This will be day 3. Really big moves. Boom, boom, boom in a row. But this is the only space we have that's green this morning. Let's see if we can find some pot stocks or EV markets or something. Yeah, we got pot stocks as well. All right, so that's not a complete wash. MSOS, for an example, trying to continue really nice range Friday, right? We had that kind of a flat top wedge, and now this breakout continuation. Oh. So we do have a perfectly set TRB. If you think about how we closed on Thursday, opened up Friday, made it to the top of the range, and now we're trying to get that continuation. We are primed for it right now. The worst thing that we got to worry about is the September 19 candle with a 50% mark. So that would be my top side first target. If we can get through that, then we've got the TRB to deal with, right? So that would be $8.53. It's kind of the 50% mark. This thing can go back to the top of the zone, call it 950 in a single day. That's why TRBs are just so fantastic, right? So I'd keep my eye on MSOS. It's not hitting the short float scan yet, but CGC is, and that's another pot stock. And CYBN, which after consolidating for a couple of days yesterday, had tried to make a move on Friday. It looks like it gave most of it back. Right, Thursday came back, and then Friday it came back. This thing is moving around this morning too, but it's not the space we want, right? Look at MSOS and CGC getting some pot stocks moving. And then of course the uranium plays. Those are just, I mean, if there was ever a textbook definition of overbought, man, that would be these at this point. Now there's other energy space like solar. So, you know, could target some solar names, and then nat gas, not overly excited about that one. And then that's it, a huge gulp down to semiconductors, and these need to be up at least 0.5% before we can start focusing on semis. The China ADRs aren't just down a little bit, they're leading to the downside, and they're down the most. Down 2.25. Behind that is FXI. So the China ETF, and then Bitcoin. And not just Bitcoin, right? Bitcoin proxies, Riot, Mara, Hut, Hive. Those would all be down this morning. Bonds, TLT. All right, so we're taking a look here at the 10-year. This is a 30-minute chart. You can see Friday we got into that 4.5 area, and we weren't able to keep it. Now look, there's someone much, much smarter than me who has talked about 4.5 right now being an absolute line in the sand, and that the end of year target is 4.7. So one, if we do get a close above 4.5, that's going to be pretty hard on the markets. It doesn't matter how bullish the setup looks in, the S&P or the Qs or whatever it is that you think you want to trade. If this thing gets above 4.5, that's a lot of weight, a lot of negative weight on the S&P and on the NASDAQ. It's hard to see them get any kind of a clean rally with that going on right here. So it's not to say it like a teeter-totter that when one side goes up, the other side must go down. It's not like that. But it is to say that it's the S&P and the NASDAQ really doesn't have a clear path up and won't make good, sharp, clean moves higher with a decent grind and a nice trend and all that. Not with this thing above 4.5. So we're looking for this to really change its shape, right? And on the weekly, which is where we're at now, that's a weekly chart here. This looks bullish, right? If that was a stock chart on, some company, we'd be buying the heck out of this thing, right? $4.581 is the measured move if we measure this range. This is just straight old textbook 101 analysis stuff, right? You measure the range, you project it upward. 50% of that range is 4.866. I don't think we'd make it that far. We're already at the warning center and we're still dealing with last week's candle. Right now, that's going to be my line in the sand. I'm kind of trying to time a little bit of a smackdown here, right? So if you're asking or thinking, why am I spending so much time on this? 4.504. That's the smackdown level. So we're looking for a solid rejection and a move to the downside. And we want it to happen, without really big, fast, sweeping moves. So just nice and easy, nothing out of control. Back away from that 4.5 and begin easing back to the downside. Now with the 10-year testing up against those highs and the dollar also right up against those highs, it's not at a breakout level yet, but even just holding at that elevated level is a threat. So we need the dollar to kind of ease off, and we need the 10-year to ease off. And then we've got the US dollar Japan here. Bank of Japan has made it clear that 152 is their line in the sand. And I continue to remind people that they don't like to wait. They give traders that number or that target as something to focus on, but then they start to put together a response and interact before we get there. I don't think for them it's a timing tool, right? It's more of when they can do it. To get that globally coordinated intervention like they had last October, it takes a lot of effort, right? You got to get all these different governments involved. Government efficiency is a little bit of an oxymoron. So, I would expect intervention either this week or next week if we continue on this path. And look at this week's candle already. So not only is this getting, a little precarious in its elevation, it's also getting near that level. And I think the intervention is imminent. So with that in mind, I wouldn't get too comfortable with my shorts, because if they do intervene, that very likely is going to be a tailwind for equities. We do have a wide double bottom here in the bonds. So another reason to believe that we could make a move up this morning is if we get support here in the bonds, we start to make our move up with the S&P making its move up, and the 10-year and the dollar both falling off of that high, then, it'd just be a nice rotation. One kind of unknown is the oil or crude sitting over here wandering around, dazed and confused, lost in the middle of nowhere. So, energy is important, so is the cost of it, but we don't have anything there yet. The chart's just sitting in the middle of nowhere. It is worth noting that US dollar Japan is making these very large sweeping moves, and the 10-year and the dollar are range bound. Okay, the EV market is getting whacked pretty hard too, so we're not going to get anything out of that direction. Oh yeah, sassy. Yeah. I don't know if you guys can hear it. My cat is yelling at me like crazy. She's got anger issues or something. So other than pot stocks and uranium stocks, we really don't have anything else. It's not much of a anticipated rally if that's all we're going to get. With that in mind, that means any rally that we do get is going to come from the indexes. So I don't expect that market breadth to be the rising tide today. Kind of a little bit of a heads up, right? It can come around and it can join in, but if we're going to get any sort of rally, it looks like it's going to come from the indexes first, and then it'll bleed out and become this rising tide for everything. So that'll at least save you from, watching the market breadth too close, because if this is what we're going to get, then watching the market breadth will be a pretty big waste of time. All right, everybody, be careful, have a good week, and I will see you all tomorrow.